Hey everyone, it's Tim Talks Finance, and today we're talking about the housing market crash. Now, I've been in the mortgage industry since 2007 and currently own a mortgage brokerage here in Arizona, so I see the ups and the downs every single day. And I want to show you guys what I've come across as far as the information behind the scenes, because all the news articles say that we're crashing, and oh my gosh, I've found some really crazy data I wanted to show you guys. So, first of all, what are the news articles saying? All right. Some of them are saying that we're going to have a decline as much as 25%. Wow. Wow. Could you guys imagine 25%? In the 2008 Great Financial Crisis, we went down 33%. So 25% down would be absolutely horrible. Okay. All right. Point number one. Housing did slip from June to August. It went down by 0.98%, which is actually pretty resilient, guys, given the fact that every time interest rates go up by 1%, that's a decrease in purchasing power of 10%. Okay, so let's think about this really quick. From June until August, we saw the prices come down by about 1%. That begs the question, how much did interest rates go up when they locked their loan? Okay, let's take a real quick look. All right, so here's the Freddie Mac average interest rate chart. And as you can see here, let's look for April. Okay, so let's say they locked their loan sometime in April. They were probably somewhere in the 5% range, okay? So 5% range, well, how much has that gone up? Well, from 2.78 up to 5, that's almost double. In some cases, I know people are getting 2.5, which is double. But either way, you get the picture. Now, you'd think if we went up from, let's say even 3%, from 3% to 5%, that's 2 points. 2% higher should mean a 20% decline. We're not seeing that. So let's look at some other stuff, because rates are starting to skyrocket, and this is what's scaring me. Okay, point number two. Interest rates have gone up. The highest since like the last 16 years. Now, the 30-year fixed mortgage rate is right now at 6.7, okay? And that's a really high amount compared to the 2.7 that everybody is used to. So that begs the question, when is this market going to crash? Because it is definitely coming. We know that. The numbers don't lie. So let's just take a really quick look at why mortgage rates and why bond rates and everything are going up so much. So first of all, it all starts with the Fed. So the Federal Reserve's two mandates are to make sure that they have price stability and to make sure that they control the job market with maximum employment. Now, recently, what they've shown is that we have about double the job openings. So if we have 100 job openings, right, then we only have 50 applicants. And what they want to do is they want to see the numbers get closer, like, hey, 50 job openings and 50 applicants. Okay, so they want to see employment basically get squashed a little bit, because if employment gets squashed a little bit, that means demand should come down. Demand comes down, then they're going to start getting a hold of this inflation problem. Now look, Jerome Powell was very firm when he gave his FOMC meeting last. And he was very firm about the job markets. He's very firm about inflation. One of the things he said that completely makes me think he is not backing off, guys, he's not backing off. And what makes me think he has credibility right now is the fact that he quoted Paul Volcker. Paul Volcker wrote a book called Keeping at It. And the other day, whenever Jerome Powell was giving his meeting at the FOMC, when he was explaining to us what happened in the FOMC meeting, he said specifically, we're going to keep at it until we get inflation under control. He wants to see the jobs market get in line. So let's see if we're heading that way. Okay, because if we're heading that way, then we're going to start to see interest rates come down. But if we're going the opposite way, then interest rates are going to go up. So let's take a look real quick. All right, so today's economic data that came out shows ISM service PMI came in at 56.7 versus 56. Now, generally speaking, in a normal market, that would be a good thing. Manufacturers are seeing a lot of demand. That's what that means is there's demand from the manufacturing side. They're ordering more goods. All right, what else do we have? We have employment was 53 versus 50.2. That's not good. It's hit. In other words, it's heading in the wrong direction. Another thing Jerome Powell said is he wants to see jobs and prices decline for a extended period of time. He doesn't want to just see it bounce around up and down and then he's just going to flip flop and go the other way on us. So what happened the other day? It's got everybody so fired up. Has to do with the Credit Suisse bank. Okay, Credit Suisse, well, they're in some bond trouble. You know, they hold some bonds, they've sold some bonds. US dollar is skyrocketing. So these mortgage-backed securities are basically like an instrument that's sold on Wall Street as a bond. That way bond investors can get their money, you know, by investing in us to buy homes. Okay, with interest rates in the 6s and the 7s, one of the things that the Fed is supposed to do is tighten the balance sheet, which means selling mortgage-backed securities. Okay, why is that such a big deal? In my opinion, here's why. You're going to have, number one, Fannie and Freddie trying to sell mortgage-backed securities so that they can provide liquidity to the market for everybody looking to purchase a home right now. Number two, you have the Fed, who a couple months ago said they were going to start quantitative tightening, which is just really a fancy way of saying that they are selling assets off their balance sheet. Mortgage-backed securities was a big asset that they picked up. It was such a big asset and they picked up so much of it, which is what drove the rates down into the 2s during the 2020 pandemic and the 2021 era. Whenever inflation started getting out of control, the Fed said, you know, maybe it's time to hike. Maybe it's time we get us out of this mess. So now we are in a mess. So I looked up how much activity they're doing with selling off these mortgage-backed securities, and here's why. If you're going to have two sellers in the market, you know, Fannie and Freddie, and now you're going to have the federal government. They're going to come together and they're going to dump mortgage-backed securities on the market. So our supply of mortgage-backed securities is going to be super, super high. What does that mean that the price will be? Super low. If the price of a bond goes low, then the interest rate goes high. Okay, it's just a direct correlation. If you're paying less money for the interest, then you get the picture. So the balance sheet. Let's see how much they've sold off since they promised us they were going to sell off this mortgage-backed security stuff. All right, assets. Here's all the mortgage-backed securities held up till September 29th of 2022. Let's just take a little, I'm going to zoom in just a little bit so we can get a tight look at what they've been doing lately. It's a little too far out to see. It's pulling right there. Okay, so at that time, approximately December of 21, no, we're going to go January of 22. Okay, so January of 22, they had approximately $2.6 trillion worth of mortgage-backed securities. If you look here, they've kind of gone up and they've gone down, gone up and they've gone down. Well, why would they go up and down? Well, when they're going down right here, that means that normally people are paying off their loan. Maybe they sold their house. It means that the maturity expired. Here's the thing. Now that we see the numbers that are going up right there, that tells me that they're not actually selling, they're buying mortgage-backed securities when they're supposed to be selling. Okay, so that's the issue I see. We haven't even dumped that $2.6 trillion worth of mortgage-backed securities, which, by the way, represents about half of all loans in the United States. Okay. Point number 3, personal income. One of the biggest things that they alluded to when they talked in the FOMC meeting was about personal income. They want to see personal income come down. Why? Because they don't want to see what they call a wage price spiral, when basically prices are going up and then they have to pay the employees more, which causes prices to go up, and then the employees demand a raise, which causes prices to go up. So they call that a wage price spiral. Okay, now let's go ahead and take a look at personal income, since we know that's what one of the things the Fed is looking at with this wage price spiral. All right, so personal income prior to the pandemic. All right. Yeah, it's going up. It's going up, and it looks like there's a big spike here, and then it went down, but it's still trending up. It's trending up. This is not what the Fed wants to see. So we haven't seen demand go down. We're starting to see crashes around the world, like the Credit Suisse. Bank of England just came out and warned the Fed that the Fed needs to reverse course on their monetary policy, or the world will go into a global recession or another Great Depression. So is that the case? Or are we basically in another housing market crash of 2008? Or is this the everything crash that Michael Burry predicted? Because I'll tell you what, there's going to be a crash of some kind. You cannot have an economic boom that's built on credit with no production and then expect not to have some kind of crash down the road. Where's that crash going to come from? My guess is everything is going up in price, and I don't think that the Fed is going to be able to get control of this inflation problem for a long time. All right, guys, that's all I got for you for today. Hope that you found this information helpful. If you like information like this, consider liking, sharing, and subscribing. We'll catch you next time.